Welcome to part 2 of the latest podcast from Global Perspectives with Alex Stanczyk, presented by Physical Gold Fund.
It all hinges on the velocity of money.
Yeah, and here's another interesting aspect of that is that velocity, what a lot of people don't realize, is closely tied to psychology. And one thing that is guaranteed is that the psychology will not stay the same forever. So it's almost like a perfect setup. Like the psychology is going to shift at some point, and when it does, it's like we're set up to unleash that gigantic dam.
That's exactly right. In many ways, inflation is more psychological than it is economics or math. I mean, it's just pure psychology. And this is where I think the Fed has really gone wrong. And this is where I think, I alluded to this in one of my recent presentations, where I think the market bailed the Fed out. What I mean by that is, if we go back 9 months or 6 months to 9 months, or let's go back a year. The Fed, raised interest rates in December of 2015 and indicated they were going to raise 2 or 3 times in 2016. Well, got into spring of 2016, they didn't do it. Got in further into the spring and they didn't do it. Got into the summer and they didn't do it. Got into the fall and they didn't do it. Right, and so they were rapidly losing credibility. Not only that, but in Europe they tried negative rates, and in Japan they tried negative rates. So all this talk of they were going to raise 3 times and they couldn't even raise once, right? And so, but yet they were like the little boy that cried wolf. They kept saying it's coming, it's coming, it's coming. Well, in the summer and in the fall, the Fed kept saying we're going to go slow, we're not ready yet. But the market, and maybe that was psychologically driven, started to say, you know what, negative rates are ridiculous. Interest rates are at 5,000-year lows. We're at negative to 0% interest rates. Do we really want to be buying bonds at negative interest rate out 50 or 60 years? I think the peak was, it was in August or September. I think Austria issued like an 80-year bond at a negative rate.
Wow.
And it's just absurd, right?
Yeah.
And so, but then there did start to be some growth prospects pick up. Some inflationary signals started to pick up. And then, Trump won, and Trump's policies, I believe, are inflationary policies, and I believe it for a little bit different reasons than a lot of other people believe it, but I think they are inflationary policies. And so into the last part, into the last 60 days before the last Fed meeting of the year, rates really started to rise, stock prices really started to rise, inflationary pressure started to rise, and I think that allowed them to raise rates. And in that way, I think the market front-ran the Fed and allowed the Fed to raise, because I'm not really sure the Fed wanted to raise, but I think they had to raise. And this is going back to the psychology. I think for the last 2 or 3 years, with the Fed saying, we're going to keep rates low, we're going to keep rates low, and other central banks saying we're not going to keep them low, we're going to go negative. This is their ivory tower working at some PhD economics department psychology, telling them if we lower rates, people will borrow more. Well, I think in the real world, the central banks are supposed to be the smartest people in the room, right? They're supposed to be the financial geniuses. Well, if the financial geniuses are telling me that things are so bad that we're going to have negative rates, why the hell would I go take out $1 million loan and build a new plant? Why the hell would I hire that new person if the smartest people in the room are telling me things are so bad we have negative rates?
Yeah.
I'm just going to wait, and when things finally get better, then I'll hire. I think that low rates and negative rates are actually deflationary, as opposed to the ivory tower opinion that it's inflationary. And now that rates started to pick up and the Fed raised, I think the market bailed them out, and I think for them to keep this momentum that they've got to keep on the raising of rates train. I mean, I think if they now go back and say, oh, we're not going to raise anymore, we're going to slow down, and then I think they lose all momentum and we go back into that deflationary environment. Because from a psychological perspective, if you've been sitting on this cash and you've been waiting for the time you haven't built that plant, or you haven't hired that person, or you haven't invested in that new project because rates are low, or maybe even going low, or maybe even going negative, and you're saying to yourself, I'm just going to wait till we get through this and things get a little bit better. Well, now if rates start to rise, maybe on the first rate rise you don't do anything, but on the second one you're probably going to start, maybe things are getting a little bit better. By the time the third or fourth raise comes along, or by the time the market takes interest rates higher, even if the Fed doesn't, now that CEO or that asset allocator or that investor says, holy cow, things are starting to take off. I need to make a move. And, then you start to see that velocity of money pick up. And then it kind of becomes a self-fulfilling prophecy to the upside. So I think that the market, and then that's where I think Trump comes in. I think Trump is such a wild card that psychologically he may change behavior in the market. Mm-hmm. Not because he's magic, and not because he's our savior, not because he's this new found hope that America is going to be great again. He's going to do things differently, rightly or wrongly. He's going to do things differently. He's going to put some policies in place that I think are inflationary. And I think if the central bank follows, quote unquote, his lead, for lack of a better word, and continues this upward projection of interest rates, then we might get some change of behavior, and we might get that velocity of money pick up. And with all those reserves that have been built up, inflation could pick up rather quickly.
Brent, can I ask you just one thing about Trump? You mentioned that you, like many people, see his policies as inflationary. I think for most people, they're thinking about his plans for massive infrastructure spending, but you indicated you had a slightly different angle on this. Could you explain why you think his policies are inflationary?
Yeah, and this is probably where I start to differ from the typical market observer, or maybe even the typical gold investor, for lack of a better word. I think the typical view, and look, I don't want to speak for anybody else, and I'm certainly not trying to put words in anybody else's mouth, but I think the common view in the precious metals community is one of the main reasons you buy gold is that fiat currencies are fundamentally flawed. The governments will print them to pay for their bad debts, and that currency will be inflated away, and so you need to own precious metals as a way of protecting that purchasing power. And that's certainly over the long term a very valid reason to own precious metals. It's maybe the top one reason to own them. That said, I don't think that is the best reason to own gold right now. I think it will be in the future, but right now, I actually think that Trump's policies are inflationary because I think it's going to lead to a stronger dollar. And I think we're going to be in a unique point in time where the stronger dollar leads to higher inflation. I know that sounds a little off or different, but and let me explain to you why. So I actually believe that we're going to get into an environment where the dollar and gold and potentially even the Dow are all going to rise together. I don't think we're there yet, but I think that's what's going to happen in the years ahead. But there's a window of time that we need to go through to get to that place. I think the strong dollar is here. Now, it may weaken a little bit over the next month or so, or maybe even over the next quarter, but I don't think it will, but if that were to happen, I think it would be a short-term thing. I did this presentation over last summer that talked about, I called it Step Into Liquid, that listed all these different reasons that I thought the dollar would get stronger. I'm happy to share that with anybody that wants to see it, but I think the Trump policies are going to make that thesis that I had even stronger, and here's the reason, is that like it or not, the world is still on a fiat system. And like it or not, the dollar, as flawed as it is, and it's extremely flawed, is still the world reserve currency. And it will be the world reserve currency until the moment it's not. And so regardless of how you view the dollar, institutions, countries, companies, corporations, people who trade, people who import and export, they need dollars to facilitate world trade. If you look at all the dollar debt in the world, we go back to this debt supercycle. I mean, there's hundreds of trillions of dollars of dollar debt in the world. Let me just give you a couple numbers. And so, long story short, I think the supply-demand issue on the dollar is going to push the dollar higher. I'll get into the reasons why here in just one second. A lot of times people will say, yes, Brent, but they can print the dollar to oblivion, and therefore they can give it all the supply that they want. Absolutely true. But right now they're not doing it. In fact, they're doing the opposite. They're decreasing the amount of money in the world, they're raising interest rates, and they're sucking all that money back into the U.S. as opposed to sending it out to the rest of the world. Now, if they change course, then fine. But right now, they are not doing it. If you go back to the supply-demand issue, there's, like I said, hundreds of trillions of debt in the world. So let me give you a few numbers. If you look just at the U.S. debt, 20 trillion. The Fed owns 2.5 of that, so let's say it's 17.5 trillion. In addition to that, we talked about the loans in the banking system. The loans in the banking system are anywhere from 10 to 12 trillion. Let's just call it 10 trillion. So you put 10 trillion on top of 17 trillion, now we're at 27 trillion. Now, outside the United States, entities, institutions, corporations, however you want to define them, outside the United States have issued another $10 trillion of dollar-based debt. So put that 10 trillion on top of the 27 we already have. Now we got 37 trillion. Okay. Now we haven't even talked about, you know, U.S. corporations at this point. So far, we've just talked about the U.S. debt, the banking system, and the international entities debt. So let's just use 37 trillion as an example. Okay. So the average interest rate on the national debt is, I think, 2.25%. $17 trillion. That would be, call it, I don't know, $300 or $400 billion, right? Okay. So then on the other 10 trillion that's in the banking system, let's just assume for the sake of argument that they can get the same rate as the risk-free rate of 2.25%, which is ridiculous, but let's just pretend they can. So that's another 250 billion of interest payments. And then we take the international 10 trillion, and let's assume they can get the same rate as the U.S. World Reserve Currency risk-free rate of 2.25%. So there's another 250 billion a year. So now we're somewhere at $700, $800 billion a year in interest payments alone for the dollar. So that is demand. That is $800 billion of demand for the dollar every year just to pay the interest, right? Without the velocity of money picking up, where are people going to get $800 billion to pay their interest payments? Well, the point is that there's a lot of demand for dollars. And we haven't even talked about the demand for trade, for new businesses. But just in interest payments alone, we're approaching $1 trillion a year in global demand for dollars. Now let's bring that back to Trump's policies. So it's a combination of Trump's policies and the Fed. So the Fed, when they were providing QE and they were, you know, giving dollars to the world that would then get, you know, either loaned into the banking system or traded, you know, the banks would use them as collateral to make trades, more dollars were being provided to the world. The spigots were open, for lack of a better word. But now rates are going up. You know, it's costing more money. Not only are we not providing new dollars to the rest of the world, but we are saying it costs more to service the ones that there already is, right? And so, you know, Trump is talking about putting up border tariffs where any goods coming into the U.S., you know, would have to pay some kind of a tax. Well, that means prices are going higher, right? That means, so even though the dollar would get stronger, the prices would go up. Prices of commodities would go up. So now we've got, you know, potentially stronger dollar and some higher prices. You know, also if you think about, you know, he has said that he would like to, you know, build a wall with Mexico, for an example. Well, you know, if Mexico, they're not going to want to pay for the wall, but he's going to try to negotiate tougher treaties with them. Now, whether he can do it or not, I don't know, but he's going to try to negotiate tougher treaties. In other words, he wants to send less dollars to them and more, you know, their stuff to us. So the point is that he wants to provide less dollars to the world and more dollars to the U.S. here. Well, that, you know, that's a strong dollar positive. And if rates continue to go up, which I think they might, and they might not, but I think that for the central banks of the world to have any chance, I think we need rates to rise because that's the only way to get the velocity of money going. Yeah. So if rates go up here and they stay flat in Japan or Europe, or they go even more negative in Japan or Europe, that should bring more, asset allocators should bring more money to the U.S. just to park it in dollars and get some kind of an interest payment rather than zero interest payment, right? So that alone makes the dollar more expensive. Then another Trump policy is he wants these corporations who have these big cash balances to bring the dollars back to bring that cash back to the U.S. Well, if he provides them, the reason they don't is because right now there's very unfavorable tax treatment. If he gives them a one-off, you know, he says, listen, you bring the cash back, we'll charge you a one-time 10 or 15% tax on it rather than the current 40% rate. You know, I can imagine a lot of people are going to bring that cash back. That makes the dollar stronger. So then the interest rates go up even higher, more capital is drawn to the U.S. And then not only that, but as the dollar gets stronger, if we go back to the 10 trillion that the international entities own, it's even harder so basically they took out big loans and they were involved in currency speculation at the same time, thinking their currencies would appreciate against the dollar. Well, now it's gone sideways on them.
Yep.
Now they're upside down. The dollar's getting more expensive.
Yep.
It's even harder for them to service that debt.
Yep.
So they go into a decline, which makes us look even better on a relative basis, which makes the dollar go even higher.
It's a self-feeding process,
I'm trying to make is you can get into this vicious circle where the dollar goes higher. And unless the Fed reverses course and starts providing more, dollars to the rest of the world, then you get into this situation where the dollar gets even stronger. And then you think of places like China, which are going through their own credit crunch, who's one of the biggest owner of treasuries. Well, there's all this money trying to get out of China. And so when the money leaves China, China has to, take the yuan that's trying to get out and give them the dollars, that are leaving. So the way that they get the dollars to give the people that are leaving is they have to sell their treasuries to provide the dollars. Well, if they sell the treasuries and they're the biggest owner of treasuries, well, then that pushes yields up on treasuries, right? So now interest rates are even higher and the dollar goes higher again. So the point is there's all these different forces. Because the world still uses the dollar as the world reserve currency, and because the world still needs dollars to operate, there's a supply-demand imbalance. It's very similar to the gold argument. What's the argument with gold is that there's not that much out there, and when the world realizes that you need gold, the demand is going to overwhelm the supply, right? And then you say, well, yeah, but there's they can just print more, and you can provide. Well, you can't print more gold, right? But you can sure as hell print more shares of GLD, and you can certainly out of thin air create more options and futures contracts on the COMEX, right? So a lot of times the community will talk about the fact that ETFs and the COMEX provides quote unquote paper gold, which keeps the price from going exponential, right? And again, that's a conversation we could spend 2 hours on that topic. The same kind of dynamics currently exist for the dollar. They can do that. They could print the hell out of it and provide as much currency as the world needs. But right now they're not doing it. And until they start doing it, demand is overwhelming supply, or I think will overwhelm supply. So that's kind of my whole Trump is inflationary perspective. I hope I made sense. I know I was rambling for a long time.
No, it makes total sense. Yeah, well, Brent, I think you do some of your best work when you're ranting there like that. That's great. It's a really good argument for a strengthening dollar. And, part of your thesis is that a strengthening dollar is actually going to cause its own destruction at some point, or its own demise at some point. Do you want to talk a little bit about that?
It's like taking steroids, right? It makes you stronger in the short term, but it ultimately kills you.
Right. Okay, so explain this. How does this happen? What does it look like when the strengthening dollar causes its own demise?
Well, I think what probably happens is that it doesn't happen right away, right? But I don't think it takes much longer for the pain to start showing up in other places around the world. So let's just assume for a second. Listen, I could be very wrong on this, but for now, let's assume that I'm right. That rates start to rise in the U.S. The Fed continues on its path of raising rates, and we start to get a little bit of inflation in the U.S. as a result. Okay, so if we take that as a assumption for right now, I think the pain starts to show up in China very quickly. I think the pain starts to show up in emerging markets very quickly. I think it's not too long in Europe before they start to feel pain as well, because they've got a number of problems, Greece and Italy being two of probably the biggest ones, not to mention dealing with Brexit. And so what I think happens is the dollar starts to escalate in price pretty quickly. And I think what happens is you start to get, and this is what I actually think a couple of Trump's cabinet picks have made comments about how the strong dollar could hurt us short term, and the dollar actually sold off on that news. And he said something like, at one point he said something like, it's nice to have a strong dollar for bragging purposes, but for other than that, it doesn't really do us a whole lot. So there's all this innuendo that Trump wants a weaker dollar. Well, I actually think he has more negotiating power with a stronger dollar, and I think I think these foreign countries and these different trade groups, he's talking about getting us out of these different these different trade treaties. I think these trading partners are going to start to complain about the strong dollar, and I think the IMF will probably start to complain about the strong dollar without some kind of a policy, and not just talk. Trump can say something and the dollar might trade down for a couple of weeks or a month or so, but unless he actually does something to weaken the dollar, the market's going to react and it's going to rebound. But I think it doesn't take much more than a year or 2 years before a bunch of the trading partners, a bunch of the IMF, some of the monetary authorities start to really talk about how the strong dollar is not conducive to world trade and world growth, and they may even have another Plaza Accord type. I think without them having some kind of a Plaza Accords type agreement,
mm-hmm.
or some kind of a coordinated, devaluation, everybody devalues against gold or something like that, I think it just goes until the strong dollar bankrupts the world. And that's why I say I think the dollar and gold rise together. As these problems start to pop up, I think gold and the dollar start to rise together. It's kind of a safe haven flight to both of those assets. Ultimately, the dollar debts will have to get bigger during all of this as well, too, right? I mean, for velocity of money to pick up, debt has to grow. We're already way in over our heads on debt, so the debt will have to get even bigger. Eventually, people will realize that debts can never get paid off. The currency in which all these debts are issued is going to have to be worthless, and that's when gold separates itself, and maybe at that point people give up on fiat currency altogether, and then maybe we go from the deflationary or the strong dollar to a weak dollar because people just flee the currency. So that's how I kind of see it playing out. I would think that in the next 12 to 24 months, the strong dollar is going to really start to hurt the global economy. And I think they will probably, I think initially they will try to do kind of these little small, half measures at best, and they'll try to talk it down. But I think eventually they're going to have to do something more dramatic and and permanent in order to combat the strong dollar. Here's the great thing about this argument. If I'm completely wrong and they reverse course and they try to inflate the way the dollar right now, I own a lot of gold, and that should do very well in that environment as well. So I think, a lot of times when I think it's my job to try to stay as impartial as possible to what's going to happen, and just try to figure out what's going to happen. And it's all about probabilities. And even if I think the probability of something happening is only 1%, I think it's part of my job to figure out, okay, so we know that we think there's only a 1% chance this is going to happen. But if that 1% chance was to happen, what would have to happen for that 1% to happen, right? And I think part of my job is to kind of think through that and really focus on that 1%, even though I don't think it's going to happen. So if that does happen, I'm not totally caught off guard, and I kind of understand the reasons why it's doing that. And I think that's one thing I would recommend to anybody is, I think sometimes it's very easy to get caught in an echo chamber. It doesn't mean that the echo chamber is wrong. The echo chamber that you're in may be 100% or 99% right? But you don't learn a lot in the echo chamber. You can learn a lot by listening to that 1%. Even if you vehemently disagree with them, listen to that 1%. Try to figure out where they're coming from, and figure out what kind of crazy scenario would have to happen for that 1% to happen. Mm-hmm. That way, if it does happen, you're not totally caught off guard.
I agree. Outstanding. You know what, Brent? I think we've got a new nickname for you. You are the 10th man. Because I don't know if you've heard of the 10th man principle, but the idea there is if there's a board of directors and the board consists of 10, that's not likely. Let's say it's 11. But let's say everybody on the board, 10 out of the 11, like if you'd be the 11th man, 10 out of the 11 all think one way. It is your duty to disagree and take the opposite position, right? So I think that's really great about the way you look at things and look for things that everybody else really isn't looking at. And so this has been a really great discussion with you today. I want to be respectful of your time, and I really appreciate you taking the time to talk to us about these things.
I appreciate you inviting me to come on. I love talking about this stuff. Listen, I've been wrong a lot of times in my life. I'm going to be wrong a lot more times. So, I like talking to people like you and others that, can agree with me on some things and disagree with me on some things. And, just talking through it really kind of helps crystallize some things, but it also helps, figure out where you might be wrong in some things. And I think the one thing I would say is, when I really started studying this stuff and really started digging in, the reason that it brought me to gold, and I know you probably agree with this as well, and, is that regardless of which way this goes, the flaw in the monetary system exists. I mean, that is a fact. It's a mathematical fact.
It's math.
And regardless of which way it goes, whether it goes south because of the deflationary forces or whether it goes south because of the inflationary forces, gold cannot be deflated away and gold cannot be inflated away. Gold's a constant. It's an element, right? And that is the one part of your portfolio that regardless of which way this resolves itself will still be standing at the end of the day. And I think that's why it has to be the anchor of everybody's portfolio, regardless of which way you think it plays out.
Totally agree. Brent, thanks so much for being with us today. Greatly appreciate your time, and we'll have to do it again sometime. And with that, John, I'm going to hand it over to you.
Well, thank you indeed, Brent Johnson, for sharing your insights with us today, and thank you, Alex Stanczyk. And most of all, thank you to our listeners for joining us in this first episode of Global Perspectives. Let me encourage you to follow Brent and Alex on Twitter. Brent's handle is Santiago AU Fund, and the Alex handle is @Alex Stanczyk. So goodbye for now, and we look forward to joining you again soon. You have been listening to Global Perspectives with Alex Stanczyk, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Alex Stanczyk and other thought leaders in the fields of geopolitics, economics, and the global monetary system.